2020 was the year that Krispy Kreme donuts had extremely long lineups, Popeyes had their amazing chicken sandwich, Apple decided to do a stock split, Tesla hit record highs, and Bitcoin became a thing again. Yet, here we are in December of 2020, looking back on everything and realizing that maybe it wasn't so terrible after all for new and novice investors. Hey guys, just Vice here. I'm going to take a look at 2020 and how it was for investors, especially new ones, and whether it was an investment opportunity or one for the books that we'd rather not take a look at. If you guys already haven't, subscribe to my channel as I'll be doing a couple more of these videos, and visit the Amazon affiliate link in my bio to go and get your Amazon goods for next time. On to the video. Looking back on 2020, we can realize that it wasn't too bad. I mean, if you disregard every single thing that happened, and I guess we had a decent Christmas. Yet, January to March wasn't too bad for the markets, and then came March 9th, when we saw a record-breaking drop on the Dow Jones. It fell by over 2,000 points, followed by two more record-setting dips on March 12th and March 16th. Now, as a fairly recent new graduate, I'm sitting here at my cubicle thinking, what the heck did I just do? This is me looking at my phone, by the way. So I'm thinking, can I actually afford to bear this loss? Or am I going to have to sell my positions and just grab whatever cash I can? At that point, I was thinking, if I've been able to save up a decent amount of coin to support myself in case if something were to happen, and if I've been able to make it through this, I think it's worth a shot and holding on to it for the long term. And that's when I learned lesson number 1. Always be patient. Looking at the market and seeing all of these dips, some would have chose to sell their positions and just grab whatever cash they could have. Yet I looked at this as an opportunity. I saw this as an opportunity to start buying at record lows and experiencing the curve that would eventually follow suit. I saw Apple hit record lows, Tesla around the $400 range, and this was before the stock split, of course. And then the Cineplex stocks, the airline stocks, and all of these home entertainment stocks take a serious beating. Yet, the tech stocks were still fluctuating around a decent range, and I still saw this as an opportunity to both average down and also pick up new stocks. As I began to average down my stocks, started picking up some more, I noticed that the stocks were still dipping and the market was still taking a pretty severe beating. And this is when I learned lesson number 2. You can never time the market. Just because you think that a stock's going to dip the day after, or it's going to go even lower, you can never wait because you honestly never know. It's all driven by supply and demand. And so I noticed that, for instance, today the Tesla stock was at 323 points. And tomorrow I was hoping that it would go down to 303. So I would have saved a whole $20. And yet the inverse were true. The next day it went up to 406. So it climbed. I could have made over $80 just by picking up that one stock the day before, had I have not thought about timing the market. So through doing so, I realized that it's better to pick it up whenever you can, because in the long term, as a long-term play, it's inevitably going to get there. So thinking about whether you're able to afford it, if you have the amount of money saved up and you're ready and willing to do it, might just be the best thing to follow rather than thinking of timing the market. If you've made it this far into the video, first off, thank you so much. Drop a like if you already haven't, and let me know what you've enjoyed so far. And then the next time that you're on Amazon or you want to go buy something, come back to one of my videos, click the link in my description for my Amazon affiliate link, and then go buy whatever you gotta do. You'll be supporting me, and I'll sincerely appreciate it. Alright, back to the video. Now, I was still commuting to and from work from January until about mid-March, and a lot of that time I would be listening to the news, podcasts, talking to some of my friends, and even at work we'd have a lot of conversations around the vaccine, if there was going to be one, the actual illness, what was going on in the world, and of course the stock market. There were a lot of decisions around you should buy this, or you should buy that, or you should sell this, and you should make some money while you can. And that's when I learned lesson number 3, crowding out all of that noise. You need to realize that the money that you invest is more than likely your own hard-earned cash. And so any decision that's made needs to be yours and yours only. So when it comes to buying that stock or selling an ETF or just cashing out and getting back all of your money, you need to have arrived at that decision on your own making and your own terms. So I realized very quickly that it was great to have these conversations with my friends and family, but at the end of the day, I had to be the one making that final call. Did I want to buy that Tesla stock when it was at $400 almost 6 or 7 months ago? Or did I want to hold out and hope that maybe it might decrease or maybe it might be less volatile? As I saw the market starting to dip and everyone else buying like crazy, I began to realize, hey, can I actually afford to do this? And that's why I wanted to make sure that I was saving most, if not all of my money, because you never know what could happen in the job market. But at the same time, I realized that once I had enough money saved up, or an amount that I was comfortable saving on a monthly basis, then only could I afford to go ahead and start investing more of my money. So for example, if I were to have gotten a bonus in 2020, I would have taken about 70% of that, invested it, and saved about 30% of that. Others may have said go with a 50-50 split, and others may have even said the inverse of investing 30 and saving 70. It all depends on what you're comfortable with. And this is where lesson number 4 comes into play. Know what you're comfortable with. You have to know your limits. A rule of thumb that I like to follow is setting aside 6 months worth of expenses as a general savings plan. And then once I've achieved that, I'll go on further and decide if I want to invest that money or save it some other way. Knowing what I'm comfortable with allowed me to navigate 2020 as an investor with a clear mind because I knew that I had a savings plan accordingly set up and I knew exactly what threshold I would need to hit before knowing when to call it a day. And for the final lesson, lesson number 5, doing your research and knowing your work. 2020 has been quite the year where the unpredictable has happened and we've been told to expect the unexpected. Quite literally almost. Who would have thought that the airline stocks would have taken such a dip and companies that were in amazing positions before 2020 would have been virtually wiped out? I mean, there are companies in downtown Toronto that I don't see anymore because they haven't been able to make their rent payments and they haven't been able to keep up with the lack of demand to stay afloat. Doing your research and knowing exactly where you're putting your money has been so crucial, especially in 2020 with all of this uncertainty. For instance, if you would have thrown in a bunch of money at the beginning of 2020 into a bunch of airline stocks, your chances of making back any returns are quite minimal. But if you would have done your research, you would have seen that around the time that the dips started happening, the airline stocks were poised for a pretty good return, especially now that they're starting to make a slow comeback. 2020 has been one of those years that we'll probably never forget. I know for me as a new investor, it took a lot of courage to actually sit through all of those losses and watch my account go from positive to serious negatives and then eventually back to pretty high positives. It's been a year where I've learned to stay patient, to do my proper research, and to really stick it through because what goes down must eventually come back up. I hope today's video was helpful and showing you some of the things that really got me through 2020 as an investor. If you already haven't, hit that subscribe button, drop a like below, and then let me know what you thought about today's video and any lessons that you may have learned as an investor in 2020. But until then, I'll see you guys next time. See ya!